Hello, everybody. My name is Bennett Tchaikovsky, the accounting professor, or I'm an accounting professor. We're going to take cash flow projections and we're going to be converting these into financial statements. Excuse me. So, disclaimer, copyright notice. The information, opinions in this presentation are those of myself and not my employers or affiliated organizations, including, but not limited to Irvine Valley College, #1 community college. I'm biased. The South Orange County Community College District, or the California State University, Fullerton. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So before we thank the bus driver, we're going to come right over here and we're going to go ahead. I'm going to pause real quick. So we have over here Oakland International Airport has the following cash flow for the months of October, November, and December. All amounts are in thousands. So we've got over here, we have cash inflows, cash from sales, total cash inflows. We have cash outflows, cost of sales, cash paid for interest, cash paid for insurance, cash paid for consulting fees, cash paid for dividends, total cash outflows, ending cash balance. And we've got some additional information. Cost of sales is cost of goods sold. The cash paid for insurance represents an insurance policy that was purchased on October 1st and will give us 12 months of insurance coverage from October 1st through September 30th. The cash paid for consulting fees was an amount prepaid to a consultant, provide him services for 6 months at a total of 10 per month from 10/1 to 3/31. Included in November cash sales was a $30,000 advance received from a customer. We will provide them services for the customer from basically from 11/1/24 through 1/31/25, and we'll say at 10 per month. Okay. Cash paid for interest represents the monthly cost on the loan payable. And then we had the following balances as of September 30th. We have cash, equipment, accumulated depreciation on equipment, and then we've got loan payable, common stock, retained earnings. The equipment was purchased on January 1st and has a salvage value of 30 and an estimated useful life of 10 years. Depreciation is taken on a straight line basis. So based on the above, we're asked to prepare the following. Basically income statements, statements of retained earnings, and then balance sheets. So for Oak, what we have to go through and do is we're going to have Oak income statements for the months ending. And this is going to be 10/24, 11/24, and 12/24. Okay. Okay, so then we're also going to be asked to prepare Oak statements of retained earnings for the months ending 10/24, 11/24, and 12/24. And then lastly, we're going to have Oak balance sheets as of 10/31/24, 11/30/24, and then 12/31/24. And I'm actually going to go ahead and change these because it just should not be. Okay, there we go. Make it a little bit more proper. Okay, there we go. All right. Let's start. The way we want to do this is that when we're going through and preparing our financial statements, we generally start with the income statement, right? We have the income statement, which would basically be sales, less expenses. And then this is going to be total expenses. And then we're going to get to our net income, right? So that's we're going to just do here, we're just going to do single step. So it's basically just going to be sales less expenses. So coming over here to the statements of retained earnings, we're going to have beginning retained earnings plus our net income. That's why we have to do the above first, less our dividends is going to give us our ending retained earnings. You feel free to abbreviate. For our balance sheets, what this is going to look like over here is we would have our assets, total assets, and I'm going to do one other thing as I'm doing this. Total assets, liabilities, total liabilities. I'm going to have owner's equity, total owner's equity, and then total liabilities and owner's equity. So this is what my balance sheet is going to go through and essentially would look like. When I'm giving this particular exam, I'm not looking for a classified balance sheet. What does that mean? You do not have to separate things into current versus non-current. Okay, so where do we start? Start with the income statement first. So over here, my sales are going to be 125,000 and 100,000, but oops, I think we kind of messed up. Why did I mess up? Well, over here, it tells us included in November cash sales was a 30 advance received from a customer. We will provide services for their customer from 1/1/24 through 1/31/25 at 10 per month. So we are not going to go through and use 100. Why is that? Well, assuming that this money was received on 11/1, right? We got cash of 100. Okay. So when we're going through and receiving cash, we're going ahead and debiting cash. What would I have credited on 1/1? Well, if I received 30 as an advance, that is going to be a liability or what we call unearned revenue. My unearned revenue is at 30. Okay. So I have 30 as unearned revenue. So the rest of this must have been sales revenue. Or over here at 70. Okay. So very important. Sales means sales that we have earned. When we look at this, we received 100. However, it tells us down below, included in this amount was a 30 advance received from a customer. I will be providing services for the customer from 11/1 through 1/31/25. So now we know at a minimum that our sales revenue is 70. However, that's incorrect. Why is it incorrect? Well, during the month, excuse me. Well, I missed it. Sorry, guys. Sorry about that sneeze. Bless myself. No, I can't say that anymore because Zoom-talk. Okay. So right over here, included in November was a 30 advance received from a customer. I'm providing services at a rate of 10 per month from November through January. So on 11/30, I would have recorded sales revenue of 10. And then I would have debited unearned revenue for 10. So let's take a step back, right? Tells me over here of this 100 that 30 was an advance received from a customer, right? And I would be doing it at 10 per month. So what that meant was when I got the money during the month, and the sales revenue could have been throughout the month. I'm just using this as an example. So of the 100 of cash, 30 was unearned. That meant that we had 70 of sales revenue based on this. However, when it comes to this unearned revenue, the unearned revenue It's not the same thing as sales. I've received in advance. I can only recognize the revenue once I've performed the services. So I would record it here as unearned revenue. And then down over here, I'd be recording this. I have to recognize 1 month of it going as sales revenue. Why is it 10? Well, 30 divided by 3 months of service is equal to 10. So over here, my sales for the month of November are going to be 70, which is from the cash that I received, plus 10 relating to the unearned revenue. So that is going to be my sales. Okay, now when we get to December, right? So my cash from sales from December would have been over here. Let's call it 12, 24, cash 140, sales revenue is going to be 140. However, I've performed another month of service, right? So this unearned revenue right over here, I performed another month. So what I'm going to go through and do is I'm going to go ahead and say unearned revenue at 10, and this is debit, credit. Okay. Unearned revenue, sales revenue over here at 10. So the total amount of sales revenue I'm going to have for December is 150. Now, what I just showed you is probably one of the more complicated things about this problem. But I'm going to show you a little trick right now in terms of going through and dealing with this that'll make your life a little bit easier later on. When we come down over here to our liabilities, unearned revenue is a liability. It is money we have received, but we have not yet performed the work for. So what I'm going to do is right now, because this is fresh in our minds, unearned revenue, right? For October, not applicable because the cash in November, not applicable because the cash was in November. However, for as of 11/30, what was my unearned revenue balance? Well, my unearned revenue balance, what did this look like? Well, unearned revenue, I started over here with a balance of 30. Then I recognized 10 for November sales. So my ending balance and unearned revenue is going to be the 30 where I started minus the 10 or 20. So that's going to be my balance of unearned revenue. So I'm going to go ahead and put that right over here. So unearned revenue is at 20. As of December 31st, what did that look like? Well, over here, my balance on 12/1/24 would be the ending balance from the prior month. My December sales caused this to go down by 10. So my ending balance and unearned revenue is going to be at 10. Okay, so coming right over here, this is going to be at 10. I am taking an extraordinarily longer time to go through and explain it because you'll probably still need to go back and review it. But if you get a question involving unearned revenue, you're going to want to take the time to make sure that your sales are good. If I just give you the sales and don't say anything else, you just write in the sales. But if I do this, you're going to absolutely want to go through and make sure that the numbers look right. Okay. So let's now go over here. So my sales less my expenses. So my cost of sales for the month of October is 30. For the month of November is 20. Month of December is 35. Now over here, there's nothing that says that this represents like, so cash paid for insurance, right? So this here relates to this. Cash paid to the consultant right over here. This over here relates to this amount right over here. Okay. Okay, so over here, and then we have these two different amounts. So let's keep going. So we have cost of sales over here, cash paid for interest. Okay, so we don't call this cash paid for interest. We're going to call this interest expense. How do I know that this is correct? Well, over here, cash paid for interest represents a monthly cost on the loan payable. And so what you would just do here, and I could also say here, the interest, just say 1% interest each month. Okay, so I have the following balances as of September 30th, 2024. Okay, so we have the loan payable. When I multiply that by 1%, I get $1,000. But right over here, we're going to have interest expense of 1,000 each month. Okay. Now, let's take a look over here. The cash paid for insurance represents an insurance policy that was purchased on October 1st and will give us 12 months of coverage from October 1st through September 30th. So we're going to have something we call insurance expense. Do we want to write 24? No, that would be the wrong answer, right? That's the amount we paid in terms of cash. And in fact, on 10/1, we basically debited prepaid insurance for 24 and we're crediting cash for 24. That's what we did on October 1st. Now, what happens at the end of the month on 10/31/24? We're going to put our mask on and go out and go trick-or-treating. But before then, we're going to go through and we need to record insurance expense. Right? When we go through and we have an insurance policy, the way we show the use of that policy is by debiting the expense, showing the use, crediting the asset. How do I record this? Okay, well, it's a $24,000 policy, 12 months of coverage. So this is going to give us 2,000 insurance expense per month. Okay. So this is going to be 2 and 2. And in fact, this is going to be the amount of the insurance expense we're going to be recognizing every single month. Okay. But while we're on this, what I do want to talk about is the balance of prepaid insurance, because the balance of prepaid insurance is going to show up as an asset on our balance sheet. Okay, so when it comes to prepaid insurance, right, I have over here my prepaid insurance balance started out over here on 10/1/24 at 24,000. I used 1 month of it. So my ending balance as of 10/31/24 is going to be 22. So I'm going to go ahead and put this over here. My prepaid insurance is going to be at 22. And this is going to go to my balance sheet. Okay, now, and this is October expense. So every month I'm recognizing the same amount of expense. So let's just go through and do this for prepaid insurance. The ending of October becomes the beginning of November. So my beginning balance here is going to be 22. My November expense is going to be 2,000 each month. So at 11/30/24, the balance is going to be 20. So 20 is going to be my balance for prepaid insurance as of November 30th. Lastly, we get over here, 12/1/24. The ending of 1 month becomes the beginning for the following. And this is going to be 12/31/24. And this is going to be my December expense. Okay, so my ending balance in prepaid insurance is going to be at 18. So again, this is why this is a lot more complicated of a question. But when you see additional information, it generally means you probably have to make some sort of adjustment. So we've dealt with these two up here. Cash is cost of goods sold. We dealt with the interest expense. We've dealt with the prepaid insurance, and we've dealt with the unearned revenue. Now let's take a look at the consulting fees. The cash paid for consulting fees was an amount that we prepaid to a consultant. The consultant will provide us services for 6 months at a total of 10 per month from October 1st through March 31st. So for this one over here, right, we're going to have, let's see here. Let me just move this over a little bit. Okay. Okay, so over here on 10/1/24, I paid cash of 60, and this was for prepaid consulting services. Okay, and this is going to be for 60. However, as they are going through and performing those services, I need to go through and recognize them at 10 per month. So what I'm going to do over here is to recognize the consulting services expense. I'm going to debit this for 10, and I'm going to credit my prepaid consulting services for 10. Okay, this is going to be 10/31/24. How did I know it's going to be 10,000? Well, it tells me over here, providing services for 6 months at a total of 10 per month from October 1st through March 31st. So coming over here, that's what this will look like. Let's take a look over here. What does the T account for this look like? Let's take a look at that. Okay. So we can kind of just borrow from here. So my consulting services expense started over here with a balance of 60. Went through and I used 10. So my ending balance is 50. Come over here to November. My prepaid, my consulting services expense. Over here, ending balance becomes beginning for the following month. I would basically repeat this entry each month. So this is going to be 11/30/24. This is going to be 12/31/24. I'm using these consulting services, right? Cash paid for consulting fees was an amount paid to prepaid to a consultant. Provide us the services for 6 months at a total of 10 per month from that period of time. So coming over here, and we've just kind of accomplished the same thing. So over here, I'm going to have consulting services expense, and this is going to be at 10 per each month. Okay. Now, to make our lives a little bit easier, prepaid consulting services is an asset. Why is it an asset? It's giving us future economic benefit. And by the way, on the prepaid insurance, I think I somehow messed this up. Let's see what's going on here. Uh-oh. Okay. So the unearned revenue was basically, it's going to go from 20 to 10. The prepaid insurance went from 22 to 20 to 18. And then my prepaid consulting services, the balance here as of October is going to be, it should not be, it's be prepaid consulting services. Sorry about that, guys. Somebody's screaming at me for this. They should be. My prepaid consulting services was 50 as of October 31st. It was 40 as of November 30th. And then it was 30 as of December 31st. The prepaid insurance, I'll link these up. 22. This is going to go over here to 20. And then this is going to go over here to 18. The unearned revenue, this is still not linked. So this will be unearned revenue, 20, unearned revenue of 10. There we go. Okay. So gone through over here. And again, you can do these problems any way you want. I'm definitely taking the longer route. It's okay. Let's go ahead and look at what else we have here. We have cash, the ending cash balance becomes the beginning of the following month. That's where that number is coming from. And let's look over here. So we've got cash, equipment. We got equipment. Okay. The equipment was purchased on January 1st, 2024, and at a salvage value of 30 and an estimated useful life of 10 years. Depreciation is taken on a straight line basis. So we're given a little bit of a clue here, right? Does depreciation expense show up on the cash flow? The answer is no. It's not going to show up here because depreciation is not a cash expense. However, we're going to need to go through and record depreciation expense for the financial statements. If I look at this number here and I eyeball it, and well, let's just go through and do the computation. The way we compute depreciation expense is our acquisition cost minus the salvage value. We divide this by the estimated useful life. My cost was 150, got that from right up here, minus 30, which is the salvage value, divided by 10. This is going to be 120 divided by 10, or annual, right? Very important. This is annual depreciation expense, right? So, but we don't want annual, we want monthly, right? So to get to monthly depreciation expense, I need to multiply this value by 1/12. Or when I take 12 times 1/12, I'm going to get 1, which is my monthly depreciation expense. So every month, because we're doing straight line, and for my exams, it will always be straight line. So over here, 1, 1, and 1. Now, how do I know if I did this correctly? Well, the asset was bought on January 1st. I'm doing my income statement starting on October 1st. That means we've had 9 months of depreciation expense. So January, February, March, April, May, June, July, August, September, 9 months. So if I take 9 times 1, I would have had accumulated depreciation of 9,000. So when we look at this, and remember, with accumulated depreciation, how do we record depreciation expense? We're debiting depreciation expense. We're crediting accumulated depreciation on that equipment. What type of account is accumulated depreciation? It is what we call a contra asset account. It's going to have a credit balance. And in fact, that's not air conditioning. So over here on 10/1/24, before we took any, it had a credit balance of 9, right? So when we go through and look at this from a balance sheets perspective, right? So our balance over here was at 9. I took a month of depreciation expense in October, right? So on 10/31/24, I would have debited depreciation expense, credited accumulated depreciation. So over here, my accumulated depreciation balance as of 10/31/24 would be 10. Okay. If I come over here, I'm doing it the following month. On 11/1/24, the ending becomes the beginning. Putting in a month of depreciation expense on 11/30/24, the balance is 11. Coming over here to the third month, right? Ending becomes the beginning. Take a month of depreciation expense, and I get 12/31/24. Remember, the numbers kind of make sense because by the end of the year, I will have taken 12 months, which is a full year because we bought it on New Year's Day. Nothing else better to do. So our depreciation expense is at 1,000 each month. And so let's also, though, talk about the balance sheet and where this shows up. For my equipment, I always show the equipment at the acquisition cost, or in this case, will be 150, less accumulated depreciation on the equipment. The accumulated depreciation balance as of October 31st was 10. So my equipment net is going to be at 140. On November 30th, again, we always show this over here at the acquisition cost. The accumulated depreciation as of November 30th is at 11. So I'm showing this over here at 139. Equipment's going to stay the same as of December. It's at 12,000. So coming over here, my equipment net is at 138. Okay. So equipment was purchased and we've dealt with this one now. So we're now ready to go through over here now. Dividends. If I'm paying dividends to my shareholders, do they go on the income statement? The answer is absolutely not, right? Basically my dividends are going to be part of the statement of retained earnings, which is the next thing we need to go through and prepare. So over here for expenses, cost of sales, interest expense, insurance expense, consulting services expense, depreciation expense of 44. So my net income is going to be 81 for November 30th, for the month of November. Total expenses are 34. Ending net income is at 46. Total expenses for the month of December are 49. My ending net income is at 101. So those are my net income. So I need to do that part first because when I come over here to my statement of retained earnings, my beginning retained earnings was 120. The ending as of June, excuse me, the ending as of September becomes my beginning for October. My net income was 81. We can just kind of fill in the net incomes that we just went through up here and did. And I had no dividends being paid for the month of October. There were none. So my total retained earnings as of October 31st is going to be 201. When this ending becomes my beginning for the following month. But over here, I paid dividends during November of 5. So my ending retained earnings is going to be my beginning plus my net income minus my dividends, or at 242. My ending balance as of November becomes my beginning balance as of December. My dividends over here were at 10. Ending retained earnings is my beginning plus my net income minus my dividends, or at 333. Now, when I'm coming over here to look at this part in terms of owner's equity, where do retained earnings go? Well, it's going to be two parts in owner's equity. There's going to be common stock and retained earnings. So over here, my retained earnings as of 10/31/24 were 201. My ending retained earnings as of as of November 30th were 242. My ending retained earnings as of December 31st were 333. Now, I've done pretty much everything here. I've got my income statements done. My statement of retained earnings is done. And now the big reveal. We got to see what our balance sheet looks like. So my cash balance is not 100. This was as of September 30th. I need to find out what my cash balance was by going here. My ending cash balance was 110. My ending cash balance as of 11:30 was 184. My ending cash balance as of 12:31 was 278. Now, as you can kind of go through over here and see, we've dealt with the cash, the equipment, accumulated depreciation on that equipment. We need to deal with a loan payable, so let's just keep going. So over here, I've got cash, prepaid insurance. Remember, we bought it for 24, but only 2 of it was expense, so the rest remained as a prepaid. Prepaid consulting services, I spent 60 on these, but it's over 6 months at 10 per month. So that's why that balance area is at 50, 40, and 30, 22, 20, and 18. It's going down by 2 each month. This accumulated depreciation started at 9, but we computed a $1,000 monthly depreciation expense. So it's going to 10, 11, and 12. Now, the net equipment over here is going to basically be the sum of these two right over here. And now we're going to get to our total assets. Note, when I'm doing these questions for my class, I generally will not have you go through and do a classified balance sheet. If you're taking my accounting 1B class, I put you through enough torture, and trust me, this is more than enough. So when I go over here, I'm just basically my total assets. I'm just adding up these amounts over here, but I do like showing this net. Just makes it a little bit easier to kind of go through and see. So these are my total assets. Remember, I'm not making you do a classified balance sheet. What's a classified balance sheet is when you're separating things between current and non-current. So coming over here is, let's take a look at our liabilities. We had our unearned revenue, but I also have a loan payable, right? The loan payable did not change because we're going through and paying the interest on that every single month. Now, my total liabilities, I had unearned revenue. There was no accounts payable, but I had unearned revenue and a loan payable. So my total liabilities as of November 31st, we're basically here at 100. Excuse me, on October 31st, we're at 100. As of November 30th, it was at 120 because we've got that unearned revenue coming in. And over here, we've got this last one over here at 110. Now, for the owner's equity, right? Total here is going to be 21, and that's going to be the common stock balance, right? So that thing is not changing. And over here, the ending retained earnings, we're reflecting those values right over here. So my total liabilities, or my total owner's equity, is going to be 222, 263, and 354. And let's hope this balances. Liabilities plus owner's equity is 322. My assets have to equal my total liabilities plus my owner's equity. Over here, this is at 383, which equals my total assets. And over here, this is at 464. When you're taking this exam, this is definitely going to be one of the longer questions that you have to go through. I spent a lot of time explaining things, but hopefully you're going to be able to find your own shortcuts for doing these. The things I can really kind of go through and ask about, obviously depreciation, some sort of like I threw in the consulting services just because I kind of wanted to play around with that and see what that looked like. The unearned revenue is always fun, but that's kind of what this looks like. You're not going to have to give any kind of opinion or anything else, but just remember, this is going to take you some time, but also remember to use this for the other question, which is this one over here, because this cash flow here that we went through and did on the other problem, you can go through and follow this format right over here. So in any event, I look forward to seeing you on future videos. Thank you for joining me here today. And thanks for liking and subscribing, and I'll see you soon. Take care.